All right, good morning, everyone. We are here for the new Capital Stack webinar, Myth-Busting Commercial Pace, put on by CleanFund, JMBM, and Koss REsource. We have Samson Lov of Koss REsource to moderate this dialogue today, and panelists Chris Robbins, Managing Director at CleanFund, and David Sudek, Partner at JMBM, as our panelists in this Q&A. We welcome questions during the session, which you can enter through the Q&A box on your Zoom meeting page. And I will hand it over to Samson to kick us off.
Thank you, Vanessa. Thank you to CleanFund and JMBM, and also to Chris and David for allowing me to moderate. And thank you to all of our participants in this morning's webinar, The New Capital Stack, Myth-Busting C-Pace or Commercial Pace. Today's session is all about commercial pace, what it is, how and when pace can fit in the capital stack, some of the benefits pace can provide. We'll answer questions about pace, whether you're a lender, developer, owner, a capital provider, or just interested in learning more about pace. You're going to leave this webinar with the answers you need in order to understand at a high level, including some detail about how commercial pace can work for you. And if you miss anything, you'll be able to receive a transcript with notes after the session. Our speakers today are Chris Robbins and David Sudek. Chris has over 28 years of experience in commercial real estate, in structured finance, renewable energy sectors, focusing on the building origination platforms, the capital deployment and business development aspects of the industry. Chris joined CleanFund as its fourth employee back in 2014, and he's focused on national partner relationships and portfolio level engagements with clients. CleanFund is a nationwide direct provider of commercial pace capital. Chris, can you tell us just a little bit about CleanFund?
Yes, thanks, Samson, and thanks everybody for joining today. CleanFund is a direct lender and is 100% focused on providing C-Pace capital to the market. We deploy our capital through a nationwide platform that we have developed to originate, underwrite, fund, and service commercial pace projects. We're located out here in just north of San Francisco in Sausalito. We have a growing team of about 35 employees across the country who are rich in experience from structured finance, commercial real estate, and lending and PACE policy. With a growing industry, CleanFund is proud to represent nearly 40% of the C-Pace originations to date, over $1 million, driving industry momentum and supporting program development and rollout in new jurisdictions.
Thanks, Chris. David Sudek is a seasoned real estate attorney with an extensive legal experience involving all types of commercial projects, but with a particular focus on hotels, golf courses, and restaurants. He frequently represents owners in the purchase and sale, development, construction, financing, leasing, and sale leaseback of properties, and advises them on their operations and management agreements. David has significant experience in the real estate finance area and represents several financial institutions as a special counsel relating to their hospitality interests. He also advises developers in the use of EB-5 financing and PACE financing as part of the capital stack for new development, and we'll go into that a little bit more. David, can you please tell us a little bit about JMBM?
Sure, thank you, Samson. I appreciate the intro. Jeffer, Mangels, Butler, and Mitchell, people often refer to it as JMBM. We're a full-service law firm. I'm part of a large interdisciplinary group of tax, employment, bankruptcy, real estate, corporate, which focuses on every aspect of the hospitality space. So I spend most of my time working in hospitality, hotels, resorts, golf courses, as you said. Technically, I'm a real estate and finance lawyer, so I'm often working with borrowers and lenders, but especially borrowers looking to acquire, reposition, or construct real property improvements. So part of my job is figuring out what is the appropriate capital stack for our borrower clients.
Thanks, David. So Chris and David have actually spoken on a number of panels together from Meet the Money this past May in Los Angeles, which is a construction lending for hospitality, who's doing it and how things are changing panel. that they were on to the Western States CREF conference in 2017 in Las Vegas from the California Mortgage Bankers Association. And they talk about alternative capital sources in the stack. So we really got to terrific experts in the field of how the capital stack works specifically to these sort of alternative kinds of financing, which is PACE, which we'll get into. I'm very pleased to have David join us to bring in third-party legal perspective around the structuring of PACE financings. And with that, David, do you currently have any clients that are either considering using or using PACE for their projects?
Yes, absolutely. I'm working on several ground-up construction, hotel, and mixed-use projects, and actually also some, deep renovations that are using and looking at using PACE. And due to the low leverage that you're getting in the construction lending world right now, just kind of what's available in the marketplace, 50-55% frequently, many of my borrower clients are exploring the use of PACE financing to increase their leverage. And I'm fortunate to have had very early experience with this form of financing. So I'm one of the few attorneys out there who's done a number of PACE deals. So I'm able to suggest PACE financing, and I actually understand what I'm proposing, which is great, as a source of capital. And then I can even help educate the lenders involved if they have not used PACE before in their transactions.
So I think I probably just, sorry, I might have gotten a little ahead of myself, but I think what we should probably do for our callers, given the questions that we've received, and for the rest of our participants, if you would like to submit questions, you can do that from the bottom of your screen by using the link to contact the moderator, to contact the host. But what I'd like to do maybe is go back to Chris and get started with a high-level overview of commercial PACE and go down sort of some of the facets. So can you just, in maybe a couple of sentences, just tell us what is commercial PACE financing?
Yes, Samson. Commercial PACE or CPACE is long-term, fixed-rate, non-recourse financing for capital improvements and new construction for commercial real estate. As assessment financing, the financing is billed and repaid through the property tax bill and is tied to the asset, not the owner.
So you said non-recourse, so that's interesting. Can you, where can it be used, like physically? Is it nationwide? Is it just in California, New York? Where can we use it?
While PACE was originally legislated in California about 10 years ago, currently 34 states and the District of Columbia have passed similar legislation. So this is existing law in 34 states in the district at this time. And as we talked about, PACE is designed to really help property owners finance property upgrades that improve the efficiency and resiliency of buildings, often reducing operating expenses and their carbon footprint. Out of the 34 states that have passed legislation, about half are currently live and we can fund in.
Okay, and you talked about non-recourse financing, but are there any other reasons that people are using CPACE?
Yes, the CPACE is a very flexible financing structure and creates a number of benefits for property owners, tenants, the environment, and today we're going to talk mostly about the owner perspective. The owners benefit from effective lower rates of financing than alternatives, mezzanine, preferred equity, bridge financing. They also benefit from longer terms ranging from 15 to 30 years. And the fact that it is non-recourse and it's a much more efficient deployment of capital in the capital stack.
And I understand that there are some benefits, but how is it structured? Is it a loan? Is it a second mortgage? Like, what is it a loan?
No, CPACE is not a loan in the traditional sense. It's actually a type of assessment financing, which historically has been used to fund voter-approved infrastructure measures, including street upgrades, building of new public schools, and other public safety improvements. CPACE and the legislation that's been passed provides property owners with the ability to use the same mechanism for eligible projects on individual buildings.
So what are the either the applications or what is the purpose of PACE? What are people using it for?
Many of our clients are utilizing PACE as part of their overall capital strategy for three primary purposes: new construction, value add acquisition and repositioning of commercial real estate assets, and general CapEx improvements to an asset or a portfolio. Some of the other areas we're seeing CPACE utilized by our clients are EB5 replacement or supplementing EB5 funding. Value engineering projects, we're seeing in this market, a lot of projects are value engineered, and we're able to come in and kind of rehydrate some of those budgets to allow the buildings to be built to their original specs. And then more and more we're seeing opportunity to work with our clients on budget overruns. So, replacement of rehydrating budgets that have gotten a little out of sort in this interesting market that we're in. And also replacement in the capital stack of higher cost mezz or bridge with lower cost long-term non-recourse capital.
Well, lower cost longer term non-recourse capital sounds very appealing. So I'm wondering how, and we actually have a question from one of our participants. What does the timing look like is the question. How does it work? What is the flow? What is the process? And then can you go into some examples? Because you did say when it qualifies, what is timing and what qualifies?
That's a great question. And due to the flexibility of CPACE and from a timing standpoint, we can get involved anywhere from the initial design, permitting of a project. We can also come in, as a sponsor is putting together their capital stack to move forward, let's say on a new construction project. We can also come in mid-construction when, as I mentioned before, there may be overruns for whatever reason. And lastly, we can come in post-construction, and in some states, depending upon how the legislation is written, up to 3 years and do a look back for reimbursement.
And what were the categories that you could actually apply PACE to? Could you go over what those were in a little bit more detail?
Absolutely. There are really 4 main categories that we can provide PACE to. And the first category is energy efficiency projects or measures. This is very wide ranging and covers measures from the envelope of a building, glazing, new roof, to major mechanical systems such as heating and cooling systems, elevators, lighting, building controls. The second category is water conservation, which generally would include low flow fixtures and irrigation and controls. The third category, renewable energy projects, which is primarily solar, and then anything really attached to these projects such as storage or EV charging stations. And the fourth, which is really kind of an interesting development over the last few years, is resiliency projects. A number of states have amended CPACE legislation to allow PACE to be utilized for, say, here in California, seismic retrofit work, in Florida, hurricane proofing.
Are there any specific property types that typically use CPACE, Chris?
Again, back to the flexibility of this financing, the property types from a commercial standpoint include office, hospitality, industrial, healthcare, retail, multifamily, but also a lot of alternative assets. We've funded 3 or 4 golf clubs, self-storage, large parking structures, and many others.
So earlier, Chris, you said this was not a loan in the traditional sense, and I'd like to get David to chime in. So, as our resident legal expert on PACE, David, can you go into some detail about either the complexity of the transactions, how that is resolved, who the parties are? So are there some different documents that would be used versus, you know, a typical loan application? Can you sort of address some of that a little bit, David?
Sure. I mean, PACE financing is complex only in that most people are not familiar with its structure. So in part, you know, our job and Chris's job is to take some of the complexity out of it by handling a lot of the back end process and just kind of explaining the overall structure. The parties involved include the developer, the person who is going to benefit from the PACE financing. This may be the property owner, it could be a tenant, but if it is a tenant, like a ground lease tenant, still the property owner needs to sign on because, as we'll talk about in a minute, there's an assessment involved, and that assessment attaches to the land. So the parties would be the developer who's benefiting from it, the property owner. If the developer is not the property owner, there's a PACE lender here, you know, CleanFund, and then there's a bond issuance, and that's how they fund the PACE financing. So in connection with a bond issuance, you'll have an issuer, a trustee, and then the person or the group that actually buys the bonds. They're buying the bonds that provide the financing that funds the PACE approved or eligible improvements. And then there's a program administrator, which I'll mention in a minute. And then you've got all of the other lenders. You've got, you know, your senior lender, if there is one, and usually there is, that has a senior secured lien against the property. You may have a mezz lender, which may be EB5 or non-EB5, and usually that's a pledge of the membership interests of the developer's entity. So if they were to default, they lose ownership of their entity as opposed to the land. And then you may even have other types of bond supported financing, like a community facilities district. And I've worked on deals that have a senior loan, PACE, community facilities district, and EB5 all in the same capital stack. And frankly, you could even overlay tax credits. So I mean, it can be a fairly diverse capital stack. The documents.
David, could you tell us a little bit about? I think you're about to go into it, but could you tell us a little bit about the documents?
Sure.
Because it sounds like there's a lot of parties, but it would be helpful to understand what documents are actually involved.
Yeah, the documents, I was going to tell you about that because, you know, again, it's very different from your typical secured loan where you have a loan agreement and then a deed of trust or mortgage and a guarantee. Here, again, it's non-recourse, so there is no guarantee involved. And the documents are those associated with a bond financing. So what you have is initially a California First application or another program application, because there are a number of programs in California, but the one I worked on was a California First application. This is the PACE financing application that starts the entire process. It's a form that's mandated by the California statewide Communities Development Authority, which they refer to as the authority, which is made up of a bunch of cities and counties in the state of California that adopted that program. So that is the first thing. You fill out the application, you submit it, and it gives a bunch of detail about what are you planning to do. And then once you get approval based on that application, the actual documents, the financing documents themselves include the agreement to pay assessments and finance improvements. They call it an assessment contract. And that's the agreement pursuant to which the owner agrees with the authority, state of California, counties and cities, that they will agree, that the property owner will agree to a contractual levy of assessments against the real property, which means that when you go to pay your real property tax bill, there's going to be another line item that says, you know, assessment or PACE assessment. You're agreeing that you can be assessed. So here in, let's say, LA County, where you pay twice a year, you're going to pay not only your real property tax, but the assessment associated with the contractual obligation under the PACE documents, this assessment contract. That's the assessment is what you use effectively to repay the PACE financing that paid for the design, the acquisition, the installation, the construction of PACE eligible improvements. So the conditions to funding are going to be set forth in either that document or in a separate document they'll call a disbursement agreement. So one or the other. And then there's the bond process. So once you've sort of agreed, okay, you may assess me, you can lien my property for the payment of assessments, they go out and they float a bond effectively, and they do that through an indenture document, and they sell the bonds to a private party or parties, and they then use the money from the bond sales to fund the PACE eligible improvements. And oftentimes there'll be the ability to advance it, even advance the bond sales, which Chris can touch on if he wants. But I've had in my PACE deals that I've worked on, there's been no delay from closing to funding. I'll tell you that. And oftentimes, I mentioned earlier, one of the stakeholders is senior lender. Just something to keep in mind is as the bond proceeds come in, you got to figure out what to do with them. And they could be held obviously by the borrower, but typically, at least in my deals, the senior lender understandably wants to take possession of them and get a pledge of them. So you're going to have a disbursement agreement typically that says, okay, bond money came in, it's now sitting with the senior lender. How does it get dispersed? And how does PACE make sure, usually through a program administrator, how does PACE make sure that those bond funds are only being used to pay for PACE eligible improvements?
And you talked about earlier, you referenced a ground lease and the improvements, which would the benefits would inure to the property owner. Can you actually use PACE on a ground lease, David?
Yes. Yeah. What happens effectively is if there's a ground lease, the PACE contracts may include an assignment by the property owner to the ground lessee of the financing proceeds. So effectively, the property owner, the fee simple owner, will sign the assessment contract, and they'll say, okay, I agree that you can lien my property and charge assessment, which will be paid as part of real property taxes. And through the lease, the property owner will tell the tenant, typically, you need to pay these assessments as you do the property taxes. It's a triple net lease. And then the property owner agrees effectively to hand the bond financing proceeds to the developer. And then the developer who's the ground lessee in this case, will use those proceeds to fund the PACE eligible improvements. So the document will have effectively two parties, and it usually includes a joinder. It'll have both the property owner and the ground lessee as the parties to the assessment contract, so it's clear as to the roles of each party. But effectively, it is the property, the underlying real property, that's going to be assessed. So you do need the fee simple owner to sign off on the assessment contract.
Can you just touch, David, on when these properties are funded through the end user of a property, like a hotel or an apartment tenant, a guest or apartment tenant, et cetera? What are those sort of documents, just at a sort of a high level for our listeners?
Yeah, I mean, at the end of the day, it's an assessment that gets paid. It comes through as an assessment against the property, like a tax. So I have seen in some of my transactions, the developer pass the cost of the assessments through to an apartment tenant or a hotel guest on a nightly basis, so that, like you do transient occupancy tax, we charge 14%. There is an option to effectively add to the overnight bill an assessment. That's something your franchisor needs to sign off on, your hotel manager needs to sign off on. It has to be, permissible by the local governmental authorities. But from what I've seen, it's been effectively passed through.
And this is Chris. We're also seeing some of our clients on the office, industrial, retail side passing through some or all of the assessment to their tenants through CAM. And again, that's very project specific in terms of the property type, the ability to pass through these assessments in the lease, and then the desire of the owner to pass through, even if they can, portion of this assessment to their tenants.
So they may be passed through, but they aren't always passed through. David, you did talk about a bond indenture. Are there any other documents that you want to reference?
There's a nice stack of documents associated with PACE financing, but I'll tell you, I mean, the most important is what we've talked about, which is the agreement to pay assessments or the assessment contract. But there are other documents involved. I mean, obviously, it attaches to your property through, in part, a notice of assessment and payment of contractual assessment required, something called a NOAA POCAR. It's a recorded instrument that just tells the world that this parcel of land is a participating parcel and it's under an assessment contract. And that's really mostly so that every successor owner knows the property is encumbered by this contractual assessment. It's used in part to perfect a first priority security interest, in the assessments, very much like a senior lender would record a mortgage or deed of trust to perfect its security interest. The taxing authorities use this NOAA POCAR to tell the world, hey, I've got this property, pursuant to an assessment contract, and I plan to have it for the full term unless it's prepaid. And we'll talk about prepayment shortly, because I know at least one question came in about prepayment. But for the life of the assessment contract, it's bound to pay the assessment unless it's prepaid. Another relevant agreement is the construction monitoring and disbursement agreement that I mentioned briefly earlier. It's basically where the parties agree that the PACE program administrator has the right to confirm that the bond proceeds are only being used to pay project, PACE eligible costs or to redeem the bonds. There's only two permitted uses of PACE monies. You can only use it to either pay for project eligible costs, things that PACE is allowed to fund, or to redeem the bonds that are being sold to fund the PACE financing. And then all the conditions to funding and the handling of draw requests and retainage, if you want to hold back, 10% from contracts, all of that is usually in the construction monitoring and disbursement agreement.
Yeah, I think it's important to note that CleanFund, we handle all of this paperwork and the documentation around the financing, so that clients or owners reps don't have to. So we coordinate all of the kind of back end here, and very important just to have that understood.
Yeah, in our last transaction, you told me I didn't even have to read the documents. That was nice.
But we have a lot of in-house counsel. It's good.
but I did nonetheless. Yeah. So there's the bond indenture, and then there's a property owner closing certificate, which is effectively all the reps and warranties of the property owner and the developer. If the developer is not the property owner, it's something that they put in their files to make sure that the property can be encumbered by an assessment. And then the most important document, and the one that takes the most of my time, is the interrelationship between the PACE lender and the senior lender. So you've got, really a lender acknowledgement, something that acknowledges on the part of the senior lender that yes, there will be PACE financing, and an intercreditor agreement oftentimes to just say, how's the funding going to work? Who's going to hold the money? In what order will the money be funded? So that is the most complex and time consuming of the documents. It's the interrelationship between the PACE financing and the senior construction lender.
Thank you, David.
Sure.
So, Chris, there were a lot of references to the senior lender and to a ground lessor in David's description of the documents and your input. And for our participants, can you address the main concerns and benefits to both of those parties, maybe starting with the senior lender?
No, absolutely. I think, first and foremost, CPACE, there's still a lot of education that's going on in the market as to what it is and how it works and potential credit issues a lender needs to think about. But the primary questions and concerns senior lenders who are just hearing about PACE for the first time generally center around their thought of being primed. Under California law, and I'll use California as an example, CPACE assessments are treated in the same manner as property taxes and other non-CPACE assessments, and therefore have an equivalent lien priority with those taxes. So we're sitting right up there with the property tax. So we're super senior to any other secured lenders. But the big issue that lenders start getting comfortable around is that in terms of delinquent property taxes, so if a building owner for whatever reason doesn't pay their property taxes, there can never be an acceleration of future assessment payments. What that means, quite frankly, is this financing can never be called and can never accelerate. So there never would be a balloon that shows up in front of a senior lender. Again, under California law, only taxes which are levied and remain unpaid are legally superior to any secured lender. Go ahead, Samson. Did you have a?
I was just gonna ask David, like in a foreclosure, David, can you talk about what happens in the instance of a foreclosure, just with respect maybe to debt coverage or generally in a foreclosure, what happens?
Yeah, I mean, I can tell you that the point that Chris brought up is really relevant in terms of getting comfort and approval from a senior lender. The fact that the entire PACE amount cannot be accelerated, that's been an important point of understanding for the senior lenders that I've worked with. And really what happens is that you've got the foreclosure process associated with PACE, which is the same as a real property tax foreclosure. It's a slow process, a multi-year process, and they can only foreclose on the amount that is due and unpaid. It cannot be accelerated. And then you've got the senior lenders process, which is a much faster process, really sort of, let's say, a 4-month process to foreclosure. So they can always foreclose, a senior lender, faster than the PACE lender can foreclose in the event of unpaid PACE assessments. But as a practical matter, if the senior lender forecloses, they foreclose on a property that is encumbered by and subject to a PACE assessment. And so that's a lot of the education process is if I'm a senior lender with a $20 million loan, and then PACE has an assessment for $5 million, if I go to foreclose, the good news is I don't need to pay off $5 million to PACE, but it does mean that when I foreclose subject to a $5 million contractual assessment. And then when I go to sell it post foreclosure, the next owner will also take it subject to that PACE assessment, obviously allowing for prepayment pursuant to the contractual terms.
Is this an appropriate time to talk about capitalized interest for Chris or David?
Yeah, I think, that capitalized interest comes into play typically for new construction or longer term rehab or repositioning projects, and is relevant in terms of, the senior lenders. Capitalized interest basically is interest that is prepaid. It's built into the PACE financing, so there is a payment due for up to 24 months post close of financing. So that gives the sponsor time to build their project and in many cases stabilize it so that they can move forward and into more permanent financing.
So how should a lender evaluate and underwrite CPACE financing? Could you go into that? I think that's sort of probably the next logical question. We have that submitted.
Yeah, so most of the time the lenders and their credit departments will look at PACE in the capital stack, and they'll do, look at a couple things. One, what is the request? So we can, go up to 20% of the value of the property. But what does that mean from a credit standpoint, from a senior lender standpoint? They're going to look at coverage ratios, so making sure that adding this PACE assessment to the property and this increase in annual property tax through the assessment that's placed on the property, in conjunction with the current debt service, stays within certain bounds, be it a 115, 120, 125 coverage ratio. So lenders look at that. They also look at what is being done. What are the projects that are being financed? And I think we're going to get into a little later some of the additional benefits of having PACE finance projects that otherwise might not be completed due to the inability of the owner to find alternative financing.
And Chris, what I'd like to ask is that for the benefit of our participants, maybe we can have somebody make a note to add some notes or comments to the dialogue and get into some of the nitty-gritty of how the debt service coverage ratios, operating expenses are impacted, or what the potential impact of those are, and we can add those to the documents that our participants will be able to receive.
Absolutely.
Could you go in a little bit, maybe more detail to the benefits to the senior lender with respect to PACE, with respect to CPACE?
Absolutely. So since CPACE is long-term in nature, often allows for value-added property improvements that, as I mentioned before, might not otherwise be possible with shorter-term financing. The improvements, in many cases, increase the value of the property, and that happens in a number of ways. One, we're seeing a number of projects where the improvements that are being financed using PACE are reducing the utility and operational costs associated with that project. And in some cases, to a point where the reduction in costs are greater than that annual assessment that's being placed on the property. We're also seeing kind of increasing tenant comfort and productivity, which leads to tenant retention and attraction. We had a group owner last week came in and they're looking at doing some major heating and cooling upgrades that they have to do to retain a tenant whose lease is coming due. We're also seeing that some of our owners and some of our clients are just looking to install and upgrade from a CapEx standpoint, outdated equipment prior to putting properties on the market because they're seeing that the market is demanding, in some cases, core markets, that these properties are already upgraded prior to transitioning.
Could you go, just to backtrack for a second, you sort of glossed over, could you actually give some specific examples of how that's being applied?
Yeah, so for instance, we were working on a project right now where CPACE financing, our financing is facilitating the implementation of a solar project. And this is an interesting one where the tenant's a triple net lease. It's an industrial, a very large industrial building, and the owner has a tax appetite. And so we're able to come in and fund the development of a solar project, and I believe they're going to add some EV charging stations and some battery storage as well. 100% of the assessment is going to be passed through to the tenants, along with 100% of the benefit, which is a reduction in the utility expense to the tenants, which is greater than the annual assessment. So there's kind of net positive cash flow that's being generated. Lastly, the owner is going to be able to harvest a 30% federal tax credit and accelerated depreciation that they otherwise would not be able to harvest without using PACE. So that's one. And as I mentioned before, we're seeing compliance and life health safety issues as well here in the Bay Area, San Francisco. There are certain seismic ordinances that are in place that specifically are tied to multifamily and what's called soft story seismic improvements that need to be made to a number of buildings in the city. And this is an interesting one because this is a new law that has to be followed. And the cost of seismic retrofit, especially to some of these larger buildings, is not insignificant. So we're working with a number of clients to provide the 30-year financing to allow the owner to move forward with those seismic retrofits to comply with the law and then all that comes with it.
And that improves collateral value.
Absolutely improves collateral value. And we're also seeing that there are some additional benefits more around the edges with insurance premiums potentially lowered once this work is complete.
So David, could we just rewind a little bit and go back to this concept of CPACE being not a loan or somehow differing from a mortgage or a deed of trust?
Sure. I'm glad you brought that up because Chris mentioned earlier installing, modern equipment to reduce price reduction in connection with selling a property. In other words, he said, let's go ahead and secure PACE financing to replace old equipment so that when you sell a property, the future property owner, buyer has modern equipment. They won't ask for a deduction due to the outdated CapEx. I think that's important because whereas a typical mortgage or deed of trust has a due on sale clause or due on encumbrance provision, and the lender can effectively accelerate or call the loan if you sell the property. You know, most loans are not assumable. PACE is fully assumable. So some developers, owners will put PACE financing on to upgrade the property in preparation for sale, and then the successor owner will effectively take on that PACE financing. So yeah, CPACE assessment is unique because it's a contractual obligation of the property that runs with the land. It's an annual levy of, you know, assessment installments over time, over the entire term, which I'll let Chris talk about the typical term of CPACE financing, but it's not something that will become immediately due or payable. It doesn't accelerate if you sell the property or foreclose on the property. It's something that you can keep for the entire initial term. And again, it's non-recourse and assumable. So it's attractive financing as long as the future senior lender is comfortable with the assessment against the property, the encumbrance.
So David, what is the typical term?
What is the typical term?
For David? I mean, excuse me, for Chris?
Yeah, let me jump in here. So from a typical term standpoint, we're seeing the majority of the terms in the 20 to 30 year range.
Yeah, my last deal was 25 years. I can tell you, just based on based on the last one, I was 25 years, but with a couple year lockout for prepayment and then a reducing prepayment schedule over time. But I'll allow Chris to kind of talk about the entire universe.
I want to go back into prepayment as well, but just to keep us on schedule. So if I heard you right, you said it's typically a 20 to 30 year typical range, and this is a fully amortizing product, yes?
Correct.
Yeah. Okay. So I'm going to touch on that again, but again, to keep us on track, David, could you just, at a very deep, high level, could you go over the concerns of a ground lessor just in summary?
Oh, sure. The typical concern of a ground lessor relates to the fact that it, meaning the property owner, is signing an assessment contract for financing that's going to be utilized by the ground lessee. So they oftentimes, the ground lessor will often look at the financing as an encumbrance against its fee simple interest. So part of the education process is, you know, is it benefiting the ground lessor through the redevelopment or improvement of a property in a way that wouldn't otherwise be undertaken. But you know what I need to do when I have a ground lessor involved is explain the joinder document, because the joinder document has the ground lessor as the property owner signing the assessment contract. So there's an immediate, you know, visceral reaction of, wait a second, why is my tenant taking financing and I'm signing for it? So that's right. That's where Chris comes in.
And Chris, for the benefit, which is the answer to that question for the ground lessor, what is the benefit to the ground lessor, Chris?
Yeah, and again, the beauty of PACE is that all of the capital that we're providing are going to specific improvements around, you know, the energy, water, life safety, you know, seismic and whatnot. So the dollars are actually going in to improve the building that's sitting on the ground lease, basically. So if you look at the Prologis Pier 1 project, the headquarters here in San Francisco, we came in and funded a solar system, heating and cooling upgrades, and other improvements that significantly increase the value of the actual property.
Well, we've gotten several questions. Several people have asked the same question, which is it possible to do CPACE with a HUD loan? And I don't want to spend too much time with this because it's probably a tough question to answer, but in short, can you do it?
It can be done. So in short, yes. And the longer answer, I think that we can follow up post this webinar to the audience, is that, you know, the state attorney general must confirm lien priority on a per program basis. There are a lot of PACE programs across the 34 states that have passed this legislation. and very few of them have gotten the confirmation from the specific state attorney general. So we'll follow up more on this, but it has been done. It can be done. It's not that easy.
Okay. David, what have you seen in the market regarding prepayment? I cut you off a little earlier, but can you go back to that real quick?
Sure. I've seen a defeasance schedule, very much like CMBS loan. I've seen a yield maintenance where effectively you need to make up for the lost interest that the PACE lender would have otherwise received. And then I've seen also a percentage of the remaining balance at the time of prepayment, and that percentage typically drops and drops and drops as you're more years into the term, and at some point, oftentimes there's no prepayment penalty of any kind. But I'd be curious to hear from Chris, what's available.
No, yeah. So from CleanFund's standpoint, PACE assessments can be partially or fully prepaid at any time, and the prepayment schedule is always negotiated, or typically negotiated, depending upon the specific project and the business plan around that asset. The calculation that we use is a percentage of the remaining principal balance at the time of prepayment. And that starts at 5% and then drops to 1% in a step down over time.
Okay.
So
and
I was going to ask Chris one follow-up question. So in your CleanFund structured PACE financing, there is no lockout period where there can be no prepayment, because some of them that I've worked on, there has been a window, 1 or 2 years, where there's no prepayment available at all.
That is correct. Prepayable at any time.
Got it.
Okay. What about closing costs, since we're on the subject of costs?
Yeah, from a cost standpoint, there are 2 primary fees at closing. One is the CleanFund financing fee. That ranges anywhere from 1.25% to 2.5%, and is primarily based upon the size of the funding amount. The smaller the amount, the higher the fee. And then there is a program fee. And as I mentioned before, there are a lot of different PACE programs in the market, and each one has its own fee schedule. We work across all programs, and the program fees and associated closing costs around the program can range anywhere from 75 basis points to 2.5%. Very important to note that all closing costs are included in the funding amount.
So it's not a traditional out-of-pocket cost.
Correct.
So again, while we're on the subject of cost, what kind of rates, Chris, are you seeing right now on PACE financing?
So that's a great question. I would say the last 10 term sheets that we've gotten out in the last 2 or 3 weeks, we've seen rates ranging from 5.5 to high 6s, and again, that's fixed over the term of the financing. Rates are again very project specific and dependent upon new construction, value add, or the product type, that will affect the rate that is presented.
Okay, and you said it depends on the size of the transaction. What are the sizes of the transactions that you're seeing? How big or small can a PACE loan be?
So PACE loans can be very small, down to $100,000. We target most of our deals in the kind of 500,000 up to 100 million. We closed the largest CPACE project to date, which was a $40 million seismic retro of Stephen Medical Center in San Francisco. Pipeline and looking at our production, most of our current business falls in the $2 to $10 million range. But again, PACE, as I mentioned earlier, is generally sized in terms of the capital stack up to 20% of the value of the building and land, post completion of the project being financed.
So it sounds like you're working on deals that are somewhere at, at a 20% range in the 10 to 50, maybe a little more, 10 to 50 plus $1 million range, or sort of the sweet spot for CleanFund.
Yeah, that's correct. We do have, the outliers. I think we've got one at 150 million that we're working on now, but that is that's not the norm.
And you mentioned that you can go as low as about $500,000. It would be about the low end, so that might be a project that's maybe a $5 to under $10 million project, but it only has about $500,000 in eligible maybe base financing, or that maybe they only need an extra $500,000.
Yeah, that's correct. The caveat there is we work more and more. We're working at a portfolio level. And there might be certain assets within that portfolio where, from an individual standpoint, there might be $200,000, $300,000 of PACE financing. In those cases, we'll move ahead and provide that financing because it's part of a larger relationship.
All right. So I have another question here, and I'm just going to read it. It's what is the application approval funding process for CPACE financing? So how do you get started, and what do you how does one of our participants, or actually we have this couple questions, how do they start?
Yeah, that's a great question. So to get started, we just launched a new tool for the marketplace so that owners and their representatives can go to quote.cleanfund.com. You can also go to our website, cleanfund.com, and go up to the top right and hit get a quote and walk through. It's a really easy to use online qualification tool. And the tool allows a property owner or their representative to determine, number one, if a property is located in a PACE Live market. And number two, upon filling out some basic information, get indicative pricing, term options, and associated annual assessments, depending upon the inputs that they put into the tool. The second way that we work on pre-qualifying or qualifying opportunities is, and we'll follow up with this post-call here, an email is sent to me or somebody on our team with an address, the project type, if it's new con, value add, CapEx improvements, the property type, office hospitality, etc. General scope and budget, and that's to determine what is PACE eligible, which we do, and then anticipated value post-completion. And with that, we can provide indicative quote. Once a quote or a term sheet is agreed upon, we then move into a letter of intent phase. Letter of intent really spells out the terms and the process to close. Once that is executed, the immediate conversation, next conversation that we have is with the lender to gain their consent. And post getting the consent of the lender, it's about a 30 to 45 day time frame to close. Okay.
Well, with that, I think it looks like we've actually answered all of the questions that were submitted, except for two specific ones, which you're going to get back to after the call. I wanted to, first of all, thank all of our participants for being on the call today, and encourage anyone who has not yet submitted a question that they're still holding on to. If we haven't answered it, please submit your questions. Reach out to myself, or better, if you want a quicker answer, contact David or Chris directly. We'll provide you with their information right here on the screen. And if anybody would like a copy of a transcript with notes, as well as the submitted questions and follow-up notes of today's webinar, I'd like to invite you to reach out to either David or Chris with the emails on your screen. Let us know, and we will get you that. Thank you to everybody for participating in today's webinar. And with that, I kick it back to you, Vanessa.
Yeah, thank you everyone for your attendance and questions. As Samson mentioned, for those that didn't get an answer, we will be responding to those in a written form that we can distribute upon request. And for the recording, should be up in about 24 hours, which we will also distribute by email. Again, we thank you for your time and listening in. And questions for Chris and David can be directed to their emails, which are currently on the screen, and we will include that in the follow-up email as well. Thank you all for your time and have a wonderful rest of your Thursday.
Yeah, thanks for the opportunity to participate as well.
Thank you.
All right.
Thank you,
Bye.
everyone.
Bye, guys.